Welcome back, Insignio family. Today is February 26th. We are joined with our credit friends from Franklin Templeton. With us today, we've got Colby mcVey, who's a senior client portfolio manager for the leverage credit team. Welcome.
Welcome. I appreciate it. Thank you all, and nice to meet you over Zoom. Quickly, Franklin Templeton Fixed Income, for everyone on the line, is a $215 billion fixed income manager at Franklin Templeton underneath the Franklin Resources umbrella. At a very high level, Franklin Templeton Fixed Income, we try to deliver a measured and no surprises approach across our fixed income strategies in the public fixed income market. We are a specialist in almost every sector. We have offices in 15 countries around the world, over 180 investment professionals around the globe as well. So big fixed income manager at Franklin Templeton, no surprises approach to fixed income, a lot of credit research analysts. We pair that with a focus on risk management. So when you think about our strategies at Franklin Templeton, think about us as more of a benchmark aware manager, taking less off benchmark risk than typical other managers, an active approach to fixed income, but very focused on optimizing outcomes for clients. So clients are very well understand our strategies very well and the types of outcomes we're trying to deliver. Again, no surprises approach to portfolio management. That's what we're shooting for at Franklin Fixed Income.
Awesome. That's great. Great way to start. So when we look at the universe, there's thousands and thousands of issues. You've got US, you've got global. The funds that we're going to dissect today are more on the US side.
Correct.
Okay.
Yep. So we're going to talk about the Putnam Ultra Short Duration Fund. We're going to talk about the Franklin High Yield Fund, US High Yield Fund. And we're going to talk about the Franklin Floating Rate Fund, or a bank loan fund.
Mm-hmm.
So we'll start with just a couple macro comments just on what we think of the universe currently, and we'll happily attach this deck. Currently, what the market is pricing into Fed funds futures curves are one cut in July and one cut in December of this year. Currently, we're at between 4.25% and 4.5%, the Fed funds rate. We think that the terminal rate of interest will get down to about 4%. And our CIO, Sonal Desai, who leads Franklin Templeton Fixed Income, she's our chief economist, chief investment officer. She's been spot on inflation and our calls on duration over the last couple of years. She thinks that the Fed funds rate will ultimately settle in around 4%.
For this year?
For not only this year, but on a go-forward basis.
Okay.
We think that that's where things are going to settle for a number of reasons. We think inflation is still a problem. That core services inflation has been difficult for the Fed to reduce as the job market has been very strong. Wage growth has been strong. That's still the case with unemployment at 4%. So that has contributed to higher earnings, good job growth, great consumer spending in the economy, and that's helped GDP, and that has helped credit in general and stocks to where they are today. So we think that strength of the economy has limited the Fed's ability to decrease inflation to their 2% target.
Yep.
Now you have a new administration in the White House. Some of the administration's policies in terms of tariffs, in terms of how we work with other countries, are slowly being figured out, but that's causing some confusion in the market.
Sure.
It's possible that you see some core goods inflation come back should you have broad-based tariffs across a number of different industries and countries. Mm-hmm. So what that means for fixed income is that the Fed's not going to be able to lower rates as much as people think they can lower them.
Yeah. And the market, I mean, we started a little offsides this year, like pricing in almost like 6 cuts.
Yeah.
That's one. Now we're like just above 2.
Yep. So in 2024, they were thinking, 6, 7 cuts in 2024. We had always held the view that we would get maybe 1 or 2 in 2024. We did get 4, in the back half of the year. They decreased rates 100 basis points.
Yeah.
But we do think that they can only decrease rates maybe one or two cuts the rest of this year. It's going to be very data dependent, obviously. But that's our base case right now. And we think that rates are going to stay higher for longer. So for fixed income, income's back in fixed income.
Yep.
Yields really going to drive returns for these asset classes we're talking about today. So, really important to understand the economy, how that's impacting fixed income for investors on the line and your clients, and how fixed income can play a role in your total portfolio, and how that can contribute to total returns going forward.
Colby, so you mentioned benchmark aware, so that means that alludes to security selection, kind of macro aware, but not taking any macro top-down calls.
Correct. So at Franklin Fixed Income, we're very bottom-up focused in our approach. We have over 50 different research analysts across credit, high investment grade, high yield, bank loans as well. And so all of those career analysts are contributing bottom-up ideas to our portfolios that we're talking about today. The credit research group works with the Putnam Ultrashort team and the high yield team. And we have a separate bank loan only research team, that one of the largest in the industry, that contributes to the Franklin Floating Rate PLC fund as well. So the benchmark aware approach that I mentioned, I don't want to get people confused that we're closet indexers. We're not.
Right.
We're taking an active approach to all of these portfolios.
Okay.
But what we're not doing is adding a bunch of off benchmark things into our portfolios.
Okay.
So I think that's important. And that's not to say that there's anything wrong with that in other managers.
Yep.
That's just our approach.
Would you guys be taking any active bets based on your view of duration?
So we typically keep duration tight. We think that we can add more value through credit selection.
Okay.
So within our ultra short duration fund, the Putnam Ultra Short Duration Fund, we have a max of 1 year duration. Currently, it's about at half a year, which is about neutral relative to the benchmark. Our high yield fund, we can have plus or minus 1 year duration in our high yield fund. Typically, we manage it 0.5 years plus or minus in the high yield fund.
And the benchmark in high yield is
the ICE B of A US high yield constrained 2% constrained index.
Okay, and that's at south of 4, the duration.
That's about 3 years duration currently.
Okay.
And with bank loans, as they are referenced to SOFR, which floats with interest rates, bank loans typically have a close to zero duration. So that's less of a concern with the bank loan asset class, and one of the reasons why I think investors have allocated to bank loans before the Fed increased rates. In addition to, we've seen a lot of flows into bank loans now because of the expectation that yields are going to stay high, and if the Fed has to raise rates again, it's not our base case.
No, right.
But if you have to raise rates, bank loans are going to increase their coupons with increasing interest rates.
Fair. Let's start with the Putnam Ultra Short duration.
Sure.
How concentrated? What's the range of holdings? Any position kind of size limits?
Yep. So inception for the onshore strategy was 2011. The offshore strategy inception was 2016. Across the ultra short team, we manage close to $11 billion in the strategy. We also have an ETF, FLUD, Frank, Larry, Umbrella, David.
Flood.
Yep, there you go. I haven't heard that one yet, but I like that. It's important. Ultra short duration strategy at Putnam. You need to think of it as we're lengthening a money market fund, not shortening a bond fund.
Okay.
Okay.
Cool.
So money market funds had certain regulations that came about after the global financial crisis that limited money market funds to certain investments they can make. They couldn't extend past 60 days in terms of maturity. So money market funds are really tied to repos, short-term commercial paper, really short-term treasury bills. The beauty of the ultra short strategy is it's an investment grade only strategy, triple B and above exposure, but we can allocate out 4 years. So the duration of the portfolio is capped at 1, as I said,
right?
But we can add weighted average maturity of securities out to 4 years. So we invest in investment grade corporates, AA, single A, in the 2, 3, and 4-year space, in addition to triple B securities in the 1-year space, high quality, CDs and other types of instruments for the ultra short duration strategy. We stress test it similar to a money market fund on a weekly basis. When I think of ultra short and you think about clients are allocating and they need that cash, I think 0 to 6 months, your clients need that cash, they stay in a money market fund. If your clients are looking and they have the flexibility of 6 to 18 months, that's where that ultra short strategy comes in. You're going to get maybe a 40 to 50 basis point increase over money market funds.
Cool.
We've seen steepening credit curves. So having a manager that can allocate to that 2, 3, 4-year part of the curve for investment grade corporates, that's going to add incremental yield over a money market fund.
Okay.
And if the Fed decreases rates for whatever reason, yield on your money market fund is going to decrease almost immediately.
Yes.
In the ultra short strategy, even if they decrease rates, because of the way we structure maturities, it's going to be much stickier.
Yeah.
Yield is going to be higher, it's going to be much stickier. So that strategy we think is a great option for clients that are maybe concerned about the economy, want to stay short, but to get a little bit more yield in a conservatively managed strategy like Putnam. We don't take any high yield. We don't have any bank loans. It's all investment grade, very high quality stuff.
Great. 170 plus issuers.
Correct.
Okay.
Yep. Banking is a big part. Banks issue both fixed and floating rate notes, investment grade related. So we have diversified exposure to banks and other sectors as well, but banks issue the majority of that short paper. So we have a large exposure to the banking sector.
Okay. So fund 1, Putnam Ultra Short, and turning to fund number 2, which is the Franklin High Yield Fund.
Yep, Franklin High Yield Fund. So high yield is a sub-investment grade asset class. So we talked about investment grade securities in Putnam Ultra Short. Now we're going down in credit quality into high yield. And down in credit quality also means higher up in yield, right? So when I think about Franklin Templeton, we've been managing high yield bonds since the 1970s. Manage over $10 billion across a number of different US, global, European custom high yield accounts. The portfolio manager who manages the high yield account has been in charge of the group since 2016. So he just passed 9 years leading the team. I mentioned the benchmark aware approach for Franklin Templeton fixed income. Very true with the high yield fund, more of a pure play approach to US high yield management. We don't add we don't add any emerging market debt. We don't add any structured products to our high yield fund. It's very much a corporate bond portfolio. We take a longer term horizon, investment horizon, roughly 3 to 5 years. So when we make an allocation to a company, we're owners of bonds, not renters of bonds. We're not trying to flip these bonds quickly. That leads to a lower turnover in the portfolio. That leads to very good relationships on Wall Street. So we get great allocations. And over time, I think what you've seen is a very good performance, not only in absolute, but risk adjusted, because our partnership with risk management is extremely important. They are there to be independent eyes on our portfolio and escalate any issues we see disagreement. So they are partners for us. And we are very much trying to deliver a smoother ride in high yield. What you don't own in high yield is just as important as what you own. And so that asymmetric payoff in high yield, you get your principal and interest back, or you default.
Right.
So defaults, number one job when we wake up in the morning is avoid defaults. And we have a huge team, 37 credit research analysts across the globe that are feeding their best ideas up to PMs.
Yep.
They are the all-stars, the analysts. They are the musicians in the orchestra. PMs are the conductors. And they're putting the portfolio together, but the analysts are the all-stars. And the way we keep good analysts at Franklin is we incentivize them appropriately. PMs and analysts are equal at Franklin Templeton Fixed Income. Analysts can make more than PMs. It's not a hierarchy. It's not a pyramid. You need more career great analysts than you do PMs. And so incentivizing them appropriately, keeping them here to generate great ideas. We think we have a good structure in place to do that. And we have analysts that have been here for 20, 30 years.
Awesome. Let's compare and contrast the public market and private markets for a second and how the workouts would take place. Are these the same analysts that would be on the team if something did go awry? And
Correct. Yeah. So the analysts and in sub investment grade land, whether it's high yields or bank loans, defaults do happen. They can happen. It's our number one job to avoid them,
right.
but they do happen.
Yep.
Our analysts are the ones that are taking these companies through bankruptcy and doing the analysis on if we should stay in that company or we should sell it. So they are intimately involved in those decisions. We have legal representation that helps us. But the analysts are the ones that are really doing the analysis on if we should sell the security or hold it. We have taken companies through bankruptcy.
Cool.
We've been on the steering committee. We've hired new management. We've helped sell assets to get money back for investors. So we have that experience. It's a high bar to take a company through bankruptcy because it's a lot of money and a lot of time. So we are selective on when we do that.
Yeah.
So we have the experience to do that.
And it's inclined to get out of a position if it starts going against you, maybe some signs that it would be.
So if we think it's undervalued, if we think there's value there, whether that's in the analysis of the plants that the company owns or the copyright or trademarks that they have, that's worth something, we'll decide if it's below value, we'll keep it and we'll commit new money to it and go through bankruptcy and receive equity rights in that new company. If it's at fair value or above value, we'll sell it and get out.
Yeah.
So it's all dependent on the analyst, but the analysts have they have the expertise to make that decision and recommend to the PM what we should do with that holding should we go through default.
Facts change, therefore I change.
Exactly. I love that quote.
How many issues should we expect?
Yep. So typically about 150 to 200 issuers. That gets us this fund. The offshore fund is almost I think it's $1.1 billion. 150 to 200 issuers. That gets us to about 300 securities.
Yep.
High 200s, 300 securities. We think that is adequately diversified. Our top holdings have I think max 1.5%. So we think that's adequately diversified, but still concentrated because we want credit selection driving attribution.
Yeah.
Right. We're trying to minimize any type of systematic beta in the portfolio. So over a market cycle, we want our beta to be very similar to the index, but we want our credit selection driving returns. And historically, if you look at our attribution in the fund, that's where we're generating performance. So we can back up what we're trying to do.
Amen. Awesome. Fund number 3, floating rate.
Floating rate.
Now, floating rate necessarily implies bank loans.
Yes. So this can be confusing at times. So floating rate loans, bank loans, leverage loans, they're all the same. So just because it says
synonymous.
Yes. Just because it says bank loans doesn't mean they're issued by a bank.
Huh.
So I know.
And that's mind blowing.
I know. So they're all synonymous with each other. But there's a very diversified sectors in the bank loan universe. The bank loan universe is about 1.4 trillion market. The high yield universe is about 1.4 trillion.
Yeah.
Private debt, 1.7 trillion.
And growing.
And growing. Probably everyone's heard a lot about that. So the bank loan market and the high yield market, if you're a CFO of a company, you have a decision. I can finance my company by issuing fixed rate debt in high yield if you're below investment grade company, or I can finance my company by issuing floating rate loans. And some CFOs would prefer to issue just high yield debt, just floating rate loans, or they can do both. And that's really a capital allocation decision based on what the company wants to do and their interest costs. And so floating rate loans are an asset class. And a couple of things I think I need to point out with floating rate loans. They are tied to SOFR, which used to be LIBOR. LIBOR went away. SOFR took its place. So as interest rates increase or decrease, that increases the coupons attached to bank loans, which go up with interest rates or down with interest rates.
Quarterly reset, monthly reset.
So bank loans are referenced to SOFR, and there's 1 month SOFR, 3 month SOFR, 6 month SOFR. So it depends on the issuer and the loan that we're lending to, or the issuer we're lending to, and the tenor of that. But because those float, the duration of bank loans is close to zero.
Right.
Right. So that's important. The other thing that's important for bank loans, typically they're senior in the capital structure. So they typically are above unsecured high yield debt. So in the event of bankruptcy, those senior secured holders are paid first before unsecured high yield debt. And so typically what that has led to is higher recoveries for bank loans over the history of the asset class.
What's been the default rate historically in this market versus high yield?
Yep. So about 3% in bank loans, about 3.5% historically in the high yield universe.
Interesting.
Yep.
Is it sector specific? We're kind of taking the lion's share of the defaults, or it's kind of evenly spread across?
So bank loans, when you look at the high yield market versus the bank loan market, the biggest sector in the high yield market is energy and financial companies. Now, financial companies in the high yield market are not like investment grade financial companies. They are very diversified. You have mortgage originators, you have mortgage servicers, you have insurance brokers, you have pawn shops, you have debt collectors. So the financial companies in the high yield sector are very diverse. So having a large analyst team allows us to really dig in to each of those subsectors.
It's almost like if you're touching money, you're part of this sector.
Yeah,
right?
yeah. And energy, for instance, and everyone remembers energy and high yield and how that has led the default cycle in high yield during the commodity crisis, during COVID. The energy sector now is very high quality and high yield. Over 60% double Bs.
Okay.
Yeah.
So
very high quality in energy in high yield now. That was not always the case.
right.
So back to bank loans, the biggest sector in bank loans is information technology and services. Reason for that is during or prior, post the GFC, when the Fed had interest rates at zero, much of the LBO and M&A that would go to the high yield market went to the bank loan market because bank loan coupons were lower than high yield because interest rates were at zero. Remember when I talked about how coupons float with interest rates in bank loans? They were lower than high yield. And so private equity companies decided, if I want to do a leverage buyout of another company, I'm going to finance that purchase by issuing bank loans because interest rates were pretty much on the floor.
Right.
And so a lot of technology companies, information technology companies, software, right? Which is a favorite of private equity companies.
Yeah.
They issued a lot of debt in the bank loan market, a lot of loan debt in the bank loan market. So that sector is the biggest sector in the bank loan market, is the technology sector.
Well, so they did well with issuing floating rate at those low
Correct.
coupon.
However, that worked for them then.
Right.
But when the Fed started increasing rates in 2022, now that is not necessarily the best thing for that sector. And so when our analysts are looking at companies in that sector, it's very much a bottom-up exercise. You have to understand what the interest coverage ratio is for each issuer, what type of balance sheet do they have, management, collateral, because bank loans are secured by collateral. That makes them senior secured. So it's a lot of analysis on what type of company or what type of buildings do they have. If they default, can we take them through bankruptcy and sell property or sell other things that's gonna get us paid back? So that's important analysis that our large independent bank loan team is charged with doing. So being active in both these sub-investment grade asset classes is extremely important.
Yes.
And we have over 50 research analysts that are doing this on a daily basis.
It seems like there's some massive synergies from having full board coverage, high yield to bank loans and back and forth.
And they're very close teammates because some companies issue both high yield debt and bank loans. What the advantage we think we have is a 14-person bank loan research team that just focuses on loan-only structures, loan-only companies. And they leverage our high yield team to do the fundamental analysis on companies that issue bonds and loans. So that kind of frees the bank loan research team up to really dig into these loan-only companies. And then they leverage the high yield team and their research if a company issues both high yield and loans. So it's a great partnership. They're very close. Most of the analysts sit with each other in San Mateo or Boston. So
My next question.
yeah, very close teams, as you would expect from sub-investment grade asset class.
Would that be safe to say then most of the credit guys are sitting either in San Mateo or Boston?
San Mateo, Boston, and New York.
New York.
Yep.
Gotta be there.
Yep. We think that, being able to have home offices in New York and Boston, given the amount of, the universities and talent in those cities, that gives us an advantage when we're hiring. It's tough to hire out in Silicon Valley.
I can.
Living standards probably down here. It's probably tough in Miami too, to hire people, just given the cost of living. But we feel like we have a diversified office, locations where we can pull in great talent.
Walk us through an example this past year where something went awry.
Yep.
How'd you guys react? How'd you work it out?
Yep.
What was the result?
All right. So many of your colleagues or clients might have heard of what's called a distressed exchange or a liability management exercise. LME is what they call it in the newspaper. So what you've seen over the last 10 years when you've issued bank loans or high yield is covenants that used to be in these credit documents that bound an issuer to adhere to certain financial metrics over time. A lot of those covenants started to go away about 10 years ago.
Just magically disappearing.
Cov-lite.
Yeah.
Cov-lite.
Like, yeah.
Is what we're hearing. So what's happening now is because interest rates have increased to a certain amount, a lot of these companies are, oh no, my business model was really structured on interest rates between 0 and 2%. And now interest rates are at 4 or 5, right? And so companies are saying, my interest costs are too high. My business isn't necessarily growing as well as I thought it was going to grow. How do I push out my debt, or how can I restructure my debt without going through Chapter 11 bankruptcy? And because of these Cov-lite credit documents over the last couple of years, has allowed companies and their private equity sponsors,
correct,
to essentially either issue new debt above senior secured holders or pull assets away from a company and put them in a different area so that lenders that thought they could lend to this company would have secured assets to sell if something were to happen. Private equity companies and others, they have the flexibility now to pull those assets away from the lenders. So as a lender, you need to be really careful. And the bar of investing in distressed companies or those that are lower quality, so B- or triple Cs, that threshold has increased for our teams because you've seen more and more of these distressed exchanges. They are a form of default without going through Chapter 11 bankruptcy. So to your original question, seeing this trend, trying to get out in front of potential companies, or if we know a company that is sponsored by a private equity company that we know well that has done this in the past, that hasn't necessarily cared about the lenders like us, what we're trying to do is analyze that business. If we foresee a potential distressed exchange on the horizon or smell that just a little bit, really reducing positions, moving out of it. We think we've done a good job of that. I think last year we got caught in one, didn't go through bankruptcy. But because we diversify our portfolios adequately, it wasn't a huge knock to performance. But that's something that I think our research teams are focused on. That is a sign in the market of stress that's not showing up in your traditional bankruptcy default rates. But it's something we're watching. And that also extends into private debt to a certain degree.
What you described on the private credit side is like PICs.
So payment in kind or toggle bonds essentially is what you're seeing. You're essentially seeing stress companies and some of these business development companies. Essentially, that's where you're first going to see it, right? What they're doing is they're not paying you cash like they said they were going to pay. They're just issuing more debt to pay at the end, right? And so that is also a form of stress potentially. And you're seeing that creep up in private credit land a bit. There's some articles out there. Typically, when you see companies doing that, typically mature companies that are doing that, that's a sign of distress. Sometimes you have newer companies that are maybe startups that are doing that because they want to keep cash on hand because they're trying to grow fast.
Sure.
So it depends. It's not just a doom and gloom if somebody does that. So it's all dependent. But that's why you have your research team there, whether that's on the public side or the private side, to help analyze that and get out of that way if you need to.
It's like poker. It depends.
It all depends, right? I know everyone hates that, but it depends. Yeah.
Amazing. We could go on for a while. We're coming up on close to the allocated time.
Sure.
Some closing thoughts for us to remember Franklin Templeton and the credit team.
Sure. So Franklin Templeton, again, measured, no surprises approach to fixed income management. Bit more benchmark aware, heavy research resources. Talked about that today. That's really important. An emphasis on risk management, incredibly important. We're trying to drive good absolute and risk-adjusted returns in a no surprises approach over long periods of time. If you are second and third quartile over long periods of time, you are first quartile.
Right. The compounding.
So that steady approach to management is really important for Franklin Fixed Income, and we think we do a great job of that. I'll leave it at that. I think fixed income in general, yields are still attractive. Spreads are pretty tight.
Sure.
So we think that, you're not going to get a lot of your return from price appreciation or spread tightening. It's really going to come from coupon, high yield, bank loans, ultra short, still within the 5, 6, 7% coupon range. So how you think about that in your overall allocation. If you're overweight to equities and you don't like the valuations, moving a little bit tactically into credit can be helpful. You haven't seen as much volatility in credit. If you go back to August of 2024, we had that sell-off after the jobs number. Stocks came down about 8, 9%. You didn't see credit move at all. So maturities, the markets have been open. Companies have good balance sheets. Profitability is still pretty good given the economy. So if you're thinking about allocations to portfolios, you can be tactical if you want to reduce some equity exposure. You can reduce some of your exposure to technology. Again, high yield's got energy, bank loans got different sectors, so you can diversify a little bit too. So we think fixed income is a great spot longer term to reach total return goals for clients, and would love to work with you and your firm in the future.
Amazing. Ladies and gentlemen, this is Colby mcVey with Franklin Templeton Credit Team. And thank you for joining. We'll see you next time.
Thank you.
Insignia Financial Group, LLC comprises a number of operating businesses engaged in the offering of brokerage and advisory products and services in various jurisdictions, principally in Latin America. Brokerage products and services are offered through Insignia International Financial Services, LLC, headquartered in Puerto Rico, and through Insignia Securities, LLC, headquartered in Miami. Both are members of the Financial Industry Regulatory Authority, FINRA, and Securities Investors Protection Corporation, SIPC. Investment advisory products and services are offered through Insignia Advisory Services, LLC, an investment advisor registered with the Securities and Exchange Commission. In Uruguay, advisory services are offered through Insignia International Asesores de Inversión Uruguay, SA, Insignia Asesores de Inversión Latam, SRL, and Insignia Asesores de Inversión de Uruguay, SRL, in Argentina, and through Insignia Argentina, SAU, and in Chile through Insignia Asesorías Financieras, SPA. Collectively, these 8 operating businesses make up the Insignia Financial Group. To learn more about the broker-dealers, including their conflicts of interest and compensation practices, please go to https://insignia.com/disclosures/ or via www.finra.org. To learn about Insignia Advisory Services and any conflicts related to its advisory services, please see its Form ADV and brochure, which can be found at Investment Advisor Public Disclosure